Matt Justice here to bring you the latest edition of the Tackle Trading Tackle 25 covered call list. As way of reminder, the Tackle 25 is not a growth list. It's a combination of growth and cash flow. The previous two editions did fairly good in 2015, 2016. Both of them overperformed the S&P 500 tremendously when you take into account both growth and cash flow. We'll talk about that later in other video series. But for right now, I want to explain kind of what cash flow strategies are. When people are fairly new to the financial markets, they don't understand that the financial markets are fairly similar to other markets out there, such as the real estate market. You have cash flow strategies in real estate, you have cash flow strategies in business, you have cash flow strategies in intellectual property, and you certainly have them in the financial markets as well in terms of the stock market. Now, most people when they look at real estate investing or stock investing and trading, they think stock's so aggressive and outlandish that let's just focus on the real estate side. And I do believe that real estate and stock are wonderful investment strategies that there's a place in a portfolio for both real estate and stock. But the reality is the common mistake people make is they assume real estate is vastly different than stock when in essence they're really very similar. In real estate you have wholesales, lease options, rentals. In stock we have covered calls, call options, and put options. But even though it's named something else, the strategy is very similar. So in real estate, you have your rental agreement to create cash flow. In the financial markets, in the stock market specifically, we have our version of rentals as well. Both of them are what we call cash flow strategies. The simple reality is that if you own anything in the marketplace, and I'm talking real estate or stock, you have the right to rent that out and to cash flow on it. Nobody in their right mind would ever buy a real estate property without the intention of generating cash flow, number one, and growth, number two. The same thing goes in the stock market. In the stock market, we're certainly looking to capture growth, meaning the stock is going to go up or the real estate property is going to go up in value. But we're also looking to create cash flow, to monetize the asset, to really create what is known as the velocity of money. Now, the first thing that we're going to do here is we're going to do a real estate analogy, and we're going to compare that to the stock. I want to give you a semi-apples to apples comparison here. Now, as the real estate investor, when you look at buying a property, there are two ways to profit off that property. The first way is what we call growth. Growth means if you buy the property for $300,000 over the next 5 years, it's going to appreciate to $400,000, $450,000, whatever that number is, but it's going to go up in value. Number two, we do it to monetize the asset, which creates velocity of money. Velocity of money is basically how fast money moves, and we rent out those properties to create cash flow. Whether that's $100 a month, $200 a month, whatever the case is, we do it property by property. And in anything in the real estate market, you can rent out single-family homes, commercial properties, mobile homes, duplexes, fourplexes. There's a lot of different ways to create cash flow in the real estate environment, and the same goes for the stock environment. So let's look at the rental agreement. The rental agreement is a two-part process. Process number one is we got to find a property. That's what we got to find. We got to find a property. Now, like I said, you can rent out many different things in the real estate arena. You can rent out all these different things, but a lot of people feel like your first property that you want to do rentals on is probably not a $10 million commercial property, but probably something safe, something simple, something like a single family home. So we're going to get a single family home. Let's say it's 1,800 square feet. Let's say it's 3-bed, 2-bath. Let's go with a $300,000 price tag. Now, we don't have to put up all the money to buy that. We only have to put up a portion of the money. The typical loan that people take in handling real estate is what we call an 80-20 loan. You're going to borrow 80%. You're going to put down in a down payment 10 to 20%. So let's say we have a 10 to 20% down payment. We have to put down $30,000 to $60,000 in down payment. Now, there's a lot of different ways we can get that money, but somehow we have to get that money, whether it's through other investments, whether it's through lines of credit, whether it's through equity in other properties, or taking out a loan from your 401k, or whatever the case is. We have to find that money to put to the down payment, and then we're going to borrow the rest of the money. So we have $60,000 down. We have a $240,000 loan. In that loan, we're also going to have a monthly cost of about $1,500 a month, give or take what the interest rate is. Now, at this point, there's no cash flow. At this point, there's no monetizing of the asset. At this point, there's no velocity to money. Nobody in their right mind, as a real estate investor, would say, well, let's go find a 3-bedroom, 2-bath. Let's go get a single-family home and let it sit there on the market and just capture growth. Nobody in their right mind would do that. They would capture the growth because they certainly expect the housing market to appreciate in value, but they're also going to monetize the asset by renting it out, which is step 2. Step 2, we have to find a tenant, we have to rent it out, and let's say we rent it out for $1,800 a month, which creates a positive cash flow of $300 a month. Now, we don't get to keep all of the $300 a month. We have costs. We have maintenance costs, vacancy costs, taxes. We have other costs associated to that, and a lot of those costs eat into that positive monthly cash flow. So let's say after all costs involved, we have $100 a month of cash flow. Now, this is a good agreement. Number one, you're exchanging money, which is a fiat currency, which is backed by faith, and you're exchanging debt, which is fake money, for the real hard asset of the property, which I like that. Number two, that is $100 a month that you did not have before you were doing this. Now, obviously, when you think about $100 a month, you're like, oh, that's not that much. But $100 a month compounded over a lifetime, it creates great wealth in that environment. And you're not just looking to do one property. You're looking to do more properties and more properties. You're looking to compound it. You're looking to leverage it. You're looking to pull equity out of the home eventually when it has some to go do it again and again and again. So when we're looking at this, what is the problem? Because when you look at it, I got an asset and I have cash flow. But you, as an investor, you got to look at two things. Number one, in the real estate arena, the number one headache that people always tell me is the exact same, and it is people. People are a headache. Some people don't pay the bill. Some people dirty up the joint. Some people don't give you a call when you don't want to get a call. It's just some people, right? Some people. And we all know what that means. What's the second problem? When it comes to investing, there is this concept that is called break even. And what break even is the average cash flow received. How long does it take to pay off the cost of the investment? And I'm not talking about the $300,000. I'm talking about the $60,000 that we put in down payment. So how long does it take me on average cash flow to break even on the investment? Well, in this example, and again, real estate is going to vary, obviously, but in this example, we have an average cash flow of $100 a month. The investor cost was $60,000. The average time to break even, we take $60,000 divided by the average cash flow. That is going to be $600, that is going to be 600 months or 50 years to break even. 50 years to break even. But what if? What if we could eliminate the tenants? What if we could get rid of all of the tenants? What if it wouldn't take 50 years or 20 years or 30 years or 40 years or even 10 years? What if you could break even in 2 years? If you could eliminate the tenants and you could break even in 2 years, would that interest you as an investor? Because as an investor, it doesn't matter if it's real estate or something else. What we are looking for is we're looking for the cash flow. So if I can eliminate the tenants and if I can erase a 90% of the time that it could take to pay off the investment, would that interest me as an investor? And obviously the answer that we all have is absolutely it would interest us if we can get the same amount of cash flow. Well, the only thing you have to do is you have to substitute the hard asset of real estate. All you do is substitute that hard asset, and you substitute it for a digital asset known as a paper asset, and that is a stock. Remember what I said initially in this video. When it comes to rentals, you can rent out anything. You can rent out currency. You can rent out commodities. You can rent out property. You can rent out stock. And that is what we call the covered call. The covered call is the primary way that stock investors create cash flow on their asset. Remember, nobody in the right mind would just buy the real estate asset. They would monetize it. They would rent it out. And in my estimation, it's not appropriate simply to buy stock to capture growth. Not when you can monetize the asset, create velocity to money, compound those gains to create wealth. And that's what the covered call is. The covered call, much like the real estate investor, there are two ways to profit. The first is if the company goes up in price. If the company goes up in price, we're going to make a portion of the growth. But you know what we're really kind of doing here? We're giving up that growth potential. Not all of it, but we are giving up a portion of that growth potential for the guarantee of cash flow. And that's what we're really looking to find. The covered call is a strategy that which we as the trader or investor, we buy a stock. We buy a stock in 100 shares increments. We can buy 100 shares, 1,000 shares, 20,000 shares, but we have to own at least 100 shares. We then sell a call option contract for each 100 shares of the stock that we own. So if we own 100 shares, we sell one call option. If we own 500 shares, we sell 5 call options. The covered call strategy is an amazing strategy to create monthly cash flow. We can do it in all types of accounts, such as an IRA, a margin account, and in that way, it doesn't matter what type of account we do it. In an IRA, we're doing it for wealth creation down the road. In a margin account, we're just doing it for cash flow purposes. Now, when you deal with trading and investing, whether it's stocks, options, currencies, commodities, or real estate, there are rules towards everything. There are rules in terms of how much time to sell. There's rules around what strike price to sell, and we'll get into that here in just one moment. But the strategy rules for the covered call, especially on the Tackle 25, is we're going to create monthly cash flow by selling the call option that is closest to 30 days of time. We're going to sell the delta, meaning the strike price, that is closest to 0.40 deltas. So for this strategy in the Tackle playbook, these are our rules. We do not question the rules. We simply apply the rules. And I'll get into that here in just one second. Now, when you deal with the options market, when you deal with the stock market, you have to understand that options are a contract. There are two types of contracts. The first contract is a call option. When you buy a call option, it gives you the right to, but not the obligation, to buy the stock at a set price on or before a set date. Typically, when people buy call options, they're doing it because they expect the stock to appreciate in value fairly quickly. Now, the second version of a contract is buying a put option. It gives you the right, but not the obligation, to sell the stock at a set price on or before a set date. Now, the two clauses in the contract that you have to concern yourself with are the set price, meaning the strike price, and the set date, meaning the expiration date. Those are what the rules are around. So whenever you deal with any strategy in the options market, you have to determine the set price. You have to determine the set date. Those are what the delta and the theta rule is. Now, what delta and theta is it's two of the what are known as the option Greeks. The option Greeks are what sets up the algorithm that determines the value of every option in the market. There are 5 option Greeks. The first one is delta, meaning direction or growth. The second one is theta, meaning time value, or specifically the decaying asset of time. As a seller, we get to capture that. The third one is vega, otherwise known as volatility. The fourth one is gamma, or rate of delta. The fifth one is rho, and what rho means is that is interest rates. Now, we're not going to get into vega, gamma, or rho in this video. This strategy, we have to understand delta and theta. Now, coming back to the contract, the first thing that you have to select is, and this is after you buy the stock, the first thing you have to select is you have to select the expiration date. You are the one that determines how much time to sell, how much cash flow to create, and that's one of the most amazing things about the covered call. So when it comes to selecting the expiration date, that's based on theta. Theta measures the option sensitivity to the passage of time. It is the one guarantee in all things of investing is that time will pass. And as time passes, the value of options will decrease over time based on theta. If you understand that, we want to sell options, because if we sell options, that tells us how much money we're going to make or how much money we're going to lose if we buy options. So if you buy an option for $100 and it has a 3 theta, you're going to lose $3 a day if you're the buyer. If you are the seller, you're going to capture that $3 a day. What that means is theta is a negative for option buyers, but it is the best friend to option sellers, meaning that cash flow is coming to us. It is the theta rule that determines the expiration. Now, when it comes to theta, theta does not decay at the exact same rate every single day. Theta increases its rapid decaying rate as it gets closer to the expiration date. So when you look at theta and you're looking at this graph, you're looking, okay, there's 30 days of time, 60 days, 90 days, 120 days, and so on and so forth. As there's more time, theta doesn't decay very much. Like with 6 months, it decays less than 0.5%. With 30 days, it's decaying 2% a day up until expiration, where it gets into where the value of the option is literally zero. So when it comes to theta, as a buyer, we want to buy more time. As a seller, meaning in a covered call, we are selling the option to capture the theta. We want to take advantage of that decaying asset of time. We want to sell that last 30 days. We want to capture that decaying rate, and we want that money coming to us every single day, every single week, every single month. So when it comes to the expiration date, the first thing we have to select is we have to select the theta number, okay? That is the expiration. We're going to go out closest to 30 days. Now, as you get a little more advanced, you can customize those rules a little bit more to who you are if you want more growth or more cash flow. But as a new trader, just focus on the rule. Let's go close to 30 days out. That tells us that we're going to cash flow over that period. Now, here you have an arrow pointing to 31. That means there's 31 days left in that contract. That is the closest to 30 days. That is the one we are going to sell. Sell the option contract closest to 30 days. In 30 days, that option has no more time. That option is going to expire worthless. That's why, as a seller, we want to sell that closest to 30 days, because it allows us to cash flow and take advantage of theta every single month, month after month after month. Now, delta determines the strike price, because there's so many different strike prices, but always come back to the contract. When you deal with the option contract, you have the right to buy, but not right to buy or sell if you're a buyer. Now, delta determines the set price, otherwise known as the strike price. What delta measures is it measures the option value given a $1 increase or decrease in the stock movement. So what delta does is it ranges from 0 to 1. Call options are positive delta, put options are negative delta. So if you buy a call option at 0.60 and it goes up $1, you're going to capture 60 cents on the dollar. Same thing on the downside, it works the same way. Now, when it comes to selling options, we don't necessarily care about that. We don't care about what the buyer is going to make or lose per $1 movement. What we care about is we want to sell the delta that is closest to 0.40. See, what delta determines is the probability of getting exercised. So if you sell a 0.40 delta, there's a 40% likelihood that that contract will get exercised, meaning you're going to sell the stock at a higher price than you purchased it for to somebody else. You're going to make money on the growth, you're going to make money on the cash flow. It means there's a 60% probability that you're simply going to cash flow, or offset risk is what you're going to do. Both of those are good things. So what delta does is it determines the strike price and the probability of us getting exercised, or the probability of us simply cash flowing. And if we get exercise, we cash flow as well. So in terms of the strike price, we're going to sell a strike price that is closest to 0.40. And as you can see, we're looking at an option chain here. It shows the delta right there on the option chain. We're going to sell that 0.37 delta. What that tells me is I am going to rent this stock out. This is AMD, by the way. We're going to rent this stock out for $14.50. We're going to buy it for $13.49. I'll walk you through that detail here in just a moment. So the 37 delta means there's a 37% probability based on the algorithm of the Black-Scholes model that we will be exercised, which means if we buy the stock at $13.50, there's a 37% chance we're going to sell it at $14.50. We're going to make the difference in the stock price, and you know what? We get to keep the cash flow. Winner, winner, chicken dinner. That also means, and when we look at that 0.37 delta, is that there's a 63% likelihood that we're simply going to cash flow, that we're going to cash flow if it's neutral, and if it starts going down in price, we're going to offset the loss by cash flowing on that. I see that as a win. Now, what we're going to do here is we're going to go live. We're going to look at the Tackle 25, the latest edition of the Tackle 25. We're going to select one of those stocks, and we're going to run the research. We're going to run the numbers to show you how it's done. Now, what you're looking at here is the latest edition of the Tackle 25. Now, a lot of work goes into this list. A lot of work in terms of fundamental analysis, technical analysis, behavioral analysis. We're looking at P ratios, growth rates, peg rates. I mean, there's this entire process that we have created at Tackle to determine what stock goes on the list. The most important, though, is cash flow, right? That's the most important. So what we're looking at is the latest list. And you see you have some basic material stocks, you have some commodity ETFs, you have the gold miners, United States Oil, you got 5 consumer good companies, a couple financial companies, 1 healthcare company on Biogen, DH Horn, which is a residential construction company and industrial goods. You have 6 different service companies and a few technology companies. What I wanted to do with this list, I wanted to create a diversified list of different sectors, different industry groups, so that regardless of what's happening in the market, we always have something that we could go to find a stock that we can cash flow on. Now, some of my favorite covered calls right now, Rig, Transocean, United States Steel. I love oil, even though it's got a small cash flow expectation. GDX is a wonderful covered call. Tesla, an amazing covered call stock. A couple different JetBlue, Southwest. But the one I'm going to look at is a technology company that is an addition to the latest edition of the Tackle 25, and that is AMD. AMD is a cheap stock. We love cheap stocks for covered calls because that allows us to buy a lot of shares. Now, in terms of AMD, the first thing I have to do, coming back to what we talked about originally, is I have to buy 100 shares, 200 shares, 300 shares. Now, the amount of shares I'm going to buy is I'm going to buy 200 shares. The reason I'm going to buy 200 shares is because I want to create a similar cash flow experience to that real estate analogy we did earlier. So currently, let's go to our broker software. Here's AMD. You can see Advanced Micro Devices, currently trading at $13.49 a share. So I'm going to buy 200 shares of that company. Now we're going to pull up a calculator here. And if I buy 200 shares of that stock at $13.49, that is going to cost me $2,698. Now, I don't have to put up 100% of the cost. Much like the real estate agreement, I only have to put up a portion of the cost. I have to put up 50% of the cost. So I'm going to divide that by 2, which means my cost basis to buy 200 shares is $1,349. Now that I own the stock, and again, 200 shares, cost basis $1,349, I'm going to go click on the strike price that is closest to 30 days out. That's 31 days from here. I'm going to scroll down. On the left-hand side is call options, right-hand side is put options. Down the middle here, these are all your strike prices. I'm going to go down to that delta closest to 0.40. That's my rules. I don't think about it. I just apply the rules. I'm going to go down to that delta closest to 0.40. That's the delta of 0.37, and I'm going to sell that contract. Now, I own 200 shares, which means I'm going to sell 2 contracts. I'm going to receive 53 cents a share. Each contract controls 100 shares, which means I'm going to receive $53 a contract. We have 2 contracts. We're going to receive in cash flow $106. Now, again, if you remember the real estate agreement, that's how much cash flow we were receiving. It's about $100. So I wanted to show an analogy where, we can create that very similar cash flow. In this capacity, it's $106. Now, before I make that transaction, I'm going to pull up the Tackle Theta research spreadsheet, and I'm going to run some numbers. Now, whenever I'm doing just one covered call, I don't care about doing this, but a lot of times, like real estate, we're going to run comps, and we're going to, a lot of times in stock, we're going to, run numbers on like 10, 12, 15 different stocks to find the best one that has the highest amount of cash flow, reward versus risk and probability. So here I got is AMD. Okay, the price $13.49. The month we are renting out is May. It's currently April, so we're going to rent out in May. It had 31 days till expiration. The call sold was $14.50. The delta was 0.37, and the credit received was 53 cents. Was bid-ask spread. Now, that's going to automatically pull up what your max profit is, what your credit ROI is, what your max return on investment. So what your credit ROI is you're going to receive 3.8% monthly cash flow. 3.8% monthly cash flow. If you look at this from an annual perspective and we go 3.8 and we times that by 12, you're looking at a 45.6% return on investment on an annual basis. That is absolutely ridiculous. But if this max ROI is if you get exercised. So if you buy the stock at $13.49 and you eventually sell it for $14.50, you get to keep the 3.8% or $53 on the credit received. Plus, you get to keep the dollar on the stock purchase, which means you have a max return in 1 month of 11.4%. That is absolutely astonishing. So now that we know that we have a good trade, we have a good investment, AMD, it's on the Tackle 25, we're renting out every 30 days, we're going to capture $53 per contract, we get a 3.8% return. So what's the next steps? What the next steps are, ladies and gentlemen, is to understand the management of the covered call. Before you ever make a trade, you have to understand what's going to happen if it goes up, down, or sideways. Now, we bought 200 shares of AMD at $13.49. We sold the $14.50 call option is what we sold. So if the stock of AMD stays under $14.50 and just goes neutral, we're going to receive a positive cash flow of $106 or that 3.8% return on investment. Now, if the stock goes up, we're going to receive the 3.8%, but we're also going to get the difference between the stock price and the call option we sold. So if the stock goes up past $14.50, that contract will be exercised. You bought the stock at $13.49, you're going to make a total a gain on the stock of $202. You bought it at $13.49, you have 200 shares, you sold it for $14.50. But once the call gets exercised, you also get to keep the $106 on the short call option in the covered call, which means you have a total gain of $308, which means you're going to capture over 11.5% return in 1 month. Now, if that happens, you just buy AMD again. If that happens, you just buy AMD and you rent it out again over and over and over. Now, what if the stock goes all the way up to, say, $20? Well, you're giving that hypothetical growth potential up. You're just giving it up. You're saying, I don't care if the stock goes to $20 in the next month. That doesn't bother me in any capacity. I want to capture the 3.8%. I want to capture the 11.5%. I want to capture that. I want the guarantee of cash flow, and I'm going to give up the growth for that guarantee of cash flow. Now, the last question is this, and this is always the biggest question I get on covered calls. But what if the stock goes down? Well, if the stock goes down, it's obviously bearish. You're going to take some degree of loss on the stock. There's no doubt about that. You're going to take a loss on the stock. But every single month you do this, you're going to reduce your cost. The way we approach covered calls is we don't get rid of them. We rent, we rent, we rent, we rent. And the reason we do this is because of break even. Remember the real estate agreement where we bought the real estate property, we rented it out, we had a break-even cost, between decades, most likely, off average cash flow divided by investment. In the stock agreement, we found a stock on the Tackle 25. We bought 200 shares of AMD. Cost basis $1,349. I have tremendously decreased the cost basis. I've created a very similar cash flow environment by renting it out at the $14.50 strike price. This created $106 a month of cash flow, which means the break even on this is 13 months. So if you get rid of it just because it goes down a little bit, you're never going to break even. But in 13 months, you have broken even off the average cash flow divided by the investment, which means now you have zero cost, which means you have an asset you can rent out for the rest of your life. You can compound those gains to create long-term wealth. So what we're going to do here is we're going to also evaluate the number one thing I love about covered calls is you have zero tenants. You are never going to get a call. You're never going to have somebody knock on your door. You're never going to have to deal with people in any capacity. You're going to click a button. You're going to create the similar cash flow environment, because at the end of the day, isn't that all we care about is the cash flow? Yeah, we might love doing other things, but we love cash flow. That's why we invest, is to create cash flow. But in the financial world, we don't have to deal with people, which is the number one headache we have as a real estate investor. So let's compare apples to apples. The real estate rental agreement average cash flow was $100. Stock was $106. The investor cost on the real estate rental was $60,000 versus the investor cost of $1,349. Average time to break even on both of them, 600 months or 50 years off the average cash flow divided by the investment. On the stock, 13 months. In the real estate agreement, you have to deal with people. Now, I love real estate. I love stock. But I love cash flow more, especially if you don't have to deal with people. And that is what the Tackle 25 is all about. The Tackle 25 is our cash flow list. It's a list of the best 25 covered call stocks in the United States stock market. These stocks are liquid. These stocks have great cash flow to them. These stocks are stocks that we can invest in and expect to receive cash flow every single month, month after month after month. We compound those gains. We create wealth with it. This is Matt Justice for Tackle Trading signing off. Good luck with the Tackle 25.